Hello everyone and welcome to the channel. The number one killer of dividend-based income is taxes, and to put it really simple, every time a company takes some of their profits and sends it to you in the form of a dividend, this is considered to be a taxable event. This is no different than every time you swipe your card at the store, that's when the government wants its sales tax, and the same thing happens when you receive a dividend. That time the government wants its tax payment too. So this means every time you receive a dividend, you pay tax. Unless your dividend stock is in a tax-free investing account like an IRA. And if you're using one of those accounts, you can ignore that for this part of the video. But for taxable accounts, which I suspect many people do have, as in the type of investment accounts that are taxed normally, there are two types of dividends: common dividends and qualified dividends. Common dividends are taxed at the exact same rate as your income. Qualified dividends, which are the ones we're going to be talking about in this video, are more desirable because they have special tax treatment. You can see that the highest level of taxation, 20%, is for people earning more than $459,000 a year for qualified dividends. On common dividends, to reach that same 20% on a normal dividend, you could earn up to only $40,000 per year before you were taxed more on your common dividends versus your qualified dividends. And now you can see why it's important outside of Roth IRAs to watch your taxes. Now with that background out of the way, let's look at the best qualified dividend companies. And for this video, I did not include any qualified dividend companies that paid less than a 2% yield. So if you feel that a company is missing from this list, that might be the reason. The first company is Rio Tinto plc. This is one of the premier blue chip mining and extraction companies. They don't just focus on a single mineral, they do everything: aluminum, copper, diamonds, golds, borates, titanium dioxide, salt, iron ore, and lithium. I read through this entire 424-page annual report, so if you can leave a like and subscribe for the insane amount of effort I put into obsessively cataloging dividend stocks for YouTube, that would help me out a lot. So this is a $93 billion market cap company that pays an 18% dividend as of this video's release. You can see that their revenue has had some trouble in the past few years, but it has been growing since 2017 and consistently posts positive net income. They buy back their shares at about 1.7% per year too, which is a plus, and they have more than enough current and long-term assets to cover their debt, and overall this is just a solid company. Mining is something we've been doing in civilization since day one, and the main threats to this company I would say are strikes from their workers, drama with governments canceling their contracts like what happened in Serbia, and other turbulence in the price of commodities. Another downside is that if you're looking for a consistent dividend, this company may not be it for you. For Rio, the dividend varies greatly from year to year and is only paid out to shareholders twice a year or semi-annually. And this is a foreign company, so you may have to pay extra ADR fees in your brokerage, but in my case it was only about 4 cents per transaction, so it wasn't that big of a deal. Nevertheless, you should be aware of it. I like to compare companies to the S&P 500. Of course, if you're looking at past performance, there may be other time frames you care about, so I encourage you to do your own research. But anyway, you can see that if you invested $10,000 in Rio in 2018, that $10,000 would be worth $16,000 with dividends reinvested, returning on average 11% per year. This narrowly beats the S&P 500 during that same time period, which returned 10.54% per year, or would have turned $10,000 into $15,764 in that same time frame. And depending how you value your investments in your stocks, this company could be seen to be on sale right now at a price-to-earnings ratio of 4 and to a price-to-sales of 1.47. But this mainly has to do with concerns about the company's profits going into the future. They reported in mid-July that they expect future performance to have some trouble because of labor shortages, muted Chinese demand, and falling commodity prices, and the threat of recession. So while this company does pay a very high qualified dividend, it's important to pay attention to what's happening behind the scenes and to avoid drama. I would say there are as many upsides to the stock as there are downsides. Watso Incorporated, or ticker symbol WSO, is a company that creates air conditioning, heating, refrigeration supplies, furnaces, heating systems, spare parts, thermostats, and the list goes on. This is a pretty non-exciting company, but I think we're seeing in market times like these, after all the flashy tech stocks and tattooed chefs, many investors are now turning to more consistent, mature companies, and those tend to be appreciated more by investors. So if we take a look at their dividends starting in 2013, their dividend has been consistently increasing. Watsco has a market cap of $10 billion and pays a 3.23% dividend yield. Every year since 2014, they've posted positive revenue growing from $3.9 billion in 2014 to $6.6 billion in 2022. They've diluted shares a little bit from 35 million outstanding shares in 2016 to 39 million in 2022. But that isn't too terrible, and that only averages out to about 1.3% of dilution per year. The dividend, on the other hand, has been growing on an average of 28%, and with some years it even grew over 70%. Their debt situation is actually quite good at the moment, with $2.3 billion in current assets to only $836 million in current liabilities. And the situation with long-term assets are even better at $1.1 billion to just $556 million in long-term liabilities. Meaning that their position is pretty strong as far as debt is concerned. As this video goes on, you'll definitely see worse debt situations. If you invested $10,000 in WSO in 2018, that investment would be worth $17,782 today, with the dividends reinvested, returning to you on average 13.5% each year, compared to just 10.5% from the S&P 500. I think that WSO is an interesting company if you believe that temperatures are going to be higher in the coming years and more people are going to be using their air conditioning services. They've paid a dividend for 48 consecutive years and raised it every single year since 2013, making it pretty desirable to dividend investors. The balance sheet is really amazing, as I mentioned before, and I don't see much competition from e-commerce on this one, as it's a very service-oriented company. You can see that they sell HVAC parts that are not sold digitally, and migration to the South in the US helps them because there are more people using these air conditioning products and services in their homes. Plus, if you're worried about government mandates on more efficient, environmentally friendly HVAC systems, they actually will benefit through the system churns as people will have to upgrade and update their HVACs and air conditioning services and systems to be more environmentally friendly. The only possible downside I could see is if you overpaid for the stock. So for that, I would whip up a model in Excel and figure out the discount rate for the stock at the current price, and make sure you don't buy it for anything below a 9% discount rate. Next up is ABBV Incorporated. This one is a pharmaceutical company with 3 leading products. There's Humira for autoimmune and intestinal diseases, Skyrizi for plaque psoriasis, and this is quite a name, RINVOQ for rheumatoid arthritis. This company has a $264 billion market cap and a 3.69% dividend yield. Looking under the hood at their financials, it actually looks quite good. Revenues have grown in the double digits every year since 2015, except for 2019, just 1 year. While there is some inconsistency in their net income, it's nowhere near as inconsistent as Rio Tinto from earlier in this video. They go back and forth between diluting shares and buying back shares to the point where they just both cancel each other out, meaning that by and large, ABBV does not buy back their shares and it doesn't really issue too many new ones either. Their dividend grew by 40% in 2018 and above 10% every following year. The debt situation for this company as of this video release has some problems. If we take a look at their balance sheet, they have about $26.5 billion in current assets, but $32.5 billion in current liabilities. Because of how short-term this debt is, if I had to guess, ABBV will likely have to find some way to pay down this debt in the future, either by issuing shares, diluting, cutting costs, and possibly cutting the dividend as well. While not perfect and very close, their long-term debt situation is more under control, with $116 billion in long-term assets and $94.3 billion in long-term liabilities. I can see why this debt-to ratio is too close to comfort for some investors. But on the upside, ABBV does have consistent positive cash flows for the past decade, meaning that their underlying businesses do seem to function well enough. And to their credit as well, their dividend has grown consistently since 2013, with no major pullbacks. If you invested $10,000 in ABBV in 2018, that investment would be worth $18,994 today, with the dividends reinvested, returning to you on average 15.17% each year versus only 10.5% for the S&P 500 in that same time period, meaning that ABBV did in fact outperform. Next up is the bank, Morgan Stanley, that I think needs very little introduction, but I will anyway to be thorough in this video report to you. Morgan Stanley is a financial holding company, and they provide various financial products and services to corporations, governments, financial institutions, and individuals in America and pretty much every continent in the world. These investment products include institutional securities, wealth management, and investment management. Morgan Stanley was founded in 1924 and is headquartered in New York City, New York. This is a $140 billion market cap company with a 3.52% dividend yield. They had one negative year of revenue growth in 2016, but have posted on average 7% revenue growth every year since 2012. If you ignore their particularly bad year in 2012 and start tracking their revenue growth from 2013, their average yearly revenue growth has been 9%. And they have been buying back their shares pretty consistently throughout the 2010s, but unfortunately they diluted their shares by 11%, putting their total share count back to 2017 levels. The good news is that it looks like their share buybacks have resumed, putting them back on the right track since then. Their balance sheet is a little different than other companies, but if you compare their total assets to total liabilities, they're in the clear with $1.2 trillion in assets and $1.1 trillion in liabilities. Their cash and cash equivalents plus receivables are enough to recover their accounts payable. They have positive financing cash flows, net cash flows, and free cash flows, showing that their underlying business is sound. For their dividend, they did have to dramatically cut their dividend in 2009 after the market crash, and they had to freeze their dividend program at low levels all the way through 2014, but since then they have been increasing their dividend. If you compare Morgan Stanley to the S&P 500 since 2018, it has outperformed, returning 13.26% each year on average, and if you invested $10,000 in Morgan Stanley in 2018, it would be worth $17,600 today. As a reminder again, while Morgan Stanley on average returned 13% each year, the S&P 500 returned on average 10.5% in that same time period. Obviously, buying an index has more diversification and less concentration risk, so with all these stocks on this list, make sure that you have to decide on whether or not you want to pick individual stocks to try to get better performance, and if it's worth the risk of concentrating your investments versus just buying an index fund. Next up is Broadcom Incorporated, ticker symbol AVGO. This is a $205 billion market cap company that designs and develops pretty much anything to do with like modern communication like Wi-Fi, semiconductors, fiber optic cables, satellite connections, everything to do with digital communications. This is what that company does. It IPO'd in 2009 and currently pays a 3.12% dividend yield. AVGO has not had a single year of negative revenue growth since 2012, and on average has grown the revenue by 31% each year, mainly because of a few banner years of revenue growth they had in 2014, 2015, 2016, and 2017. The revenue growth has slowed down since then, but 15% revenue growth is a lot better than many companies on the stock market today. The company only had one unprofitable year in 2017, but compared to many other companies, they have been diluting their shares a great deal. In fact, more compared to other companies on this list. That said, the dividend for AVGO has grown every year since 2012, at often more than 50% dividend growth each year. Their balance sheet and debt situation has nothing to complain about, with $14.8 billion in current assets to just $6.9 billion in current liabilities, with $56.9 billion in long-term assets to their $43.8 billion in long-term liabilities. And while this isn't an ironclad fortress balance sheet, it's actually not very bad at all. There's not much to complain about their debt situation. You can see they've had free positive cash flows each year. You can see too, since 2011, they've dramatically increased their dividend consistently as well without wild swings in dividend payouts each year. It's the same consistent track record of dividend increases. And this is one of the better dividend growth charts I've seen so far while making this video. If you invested $10,000 in AVGO in 2018, that $10,000 would be worth $22,641 today with the dividends reinvested. AVGO dramatically outperformed the S&P 500, returning on average 19.71% each year, compared to only 10.54% for the S&P 500. Next up is Blackstone, ticker symbol BX. This is a $118 billion market cap asset management firm specializing in real estate, private equity, hedge fund solutions, credit and secondary funds, public debt, and equity of multi-asset class strategies. If you saw rumor articles around the last year about how BlackRock was buying up residential real estate, that actually was Blackstone doing that. BlackRock just caught the bad rap for it. And what they actually did was they were acquiring smaller companies going into the suburbs and creating a new business model there. They were just buying the companies that were already successfully doing that and bringing them under their asset management umbrella. But anyway, outside of the recent news, their dividend yield is 4.61%, which is one of the higher yields on this list. Blackstone had an amazing year in 2021, growing their revenues 270%, but prior to that, the revenues had been pretty inconsistent, going up some years and going down many other years. They also do dilute their shares pretty consistently, on average about 3.7% each year, which is a high rate of share dilution compared to most of the companies in this video. That said, compared to other hype growth stocks, 3.7% is a relatively low share dilution rate. For example, Tesla in many years diluted their shares above 10%, and Tattooed Chef has diluted their shares sometimes above 100%. So 3.7% isn't that bad depending on how you look at it. And how share dilution works is that a company will issue more shares and sell those shares in the stock market for cash at the cost of making your ownership percentage of the company smaller. So take for example, if you have a company with 10 shares and you have 5 of those shares, meaning you own half of the company, 50%, and that same company decides they're going to issue 5 more additional shares, suddenly you only have 5 because you didn't change your shares. You only have 5 out of 15 shares, leaving you with just 33% now of the company. And you can see that's a dramatic decrease in your ownership. And that's why share dilution is bad for an investor. It's not the end of the world if you do get diluted, but it's very important to look at share dilution in a company before you invest in it, because you want to see if a company is using your money intelligently and not diluting you and taking away your stock gains and profits. Their debt situation is actually very good, with their assets outnumbering their liabilities by a ratio of 2 to 1. This is actually, if you take a look, what I would call an ironclad fortress balance sheet. Now, if we look at the stock chart for Blackstone, keeping in mind they did have an amazing year in 2021, but even with that in mind, this is a crazy stock chart, and you can tell that they've done amazing since 2021, but they may not have a repeat of that year, and I will say these returns are heavily skewed by a single home run year for the company. Anyway, if you invested $10,000 in Blackstone in 2018, that $10,000 will be worth $37,635 today, which is by far the best on the list so far. That's an average return of 33.88% each year compared to just 10.5% for the S&P 500. Their dividend has been extremely inconsistent, changing year to year, sometimes by as much as 50%. So if you're looking for consistent dividend income, this company may have some difficulty getting that to you. And given the dramatic increase in Blackstone's share price, I also would be careful to do your own deep fundamental analysis to figure out what's a good price to pay and not overpay for this stock. Next up is Novartis, which is a Swiss company, so be careful of taxes on foreign dividends, but even still it should have a better tax treatment than common dividends. This is a healthcare company that does just about everything. And it's really too much to talk about in this video. It's literally everything in the pharmaceutical industry. So what I would do before investing is I would read up and understand exactly how their business works, even down to the smaller segments, before you make a decision. This is a $190 billion market cap company that pays a 3.87% dividend yield. But now this is where it gets a little bit ugly. Biotech and pharmaceuticals are a little bit of a chaotic industry, as you saw before with ABBV. And Novartis is no different. Their revenue was dropping pretty consistently from 2015 to 2017, and they only recovered to their 2015 levels of revenue in 2021. But to their credit though, during that time when they were building back their revenue, they were buying back shares to stabilize their stock price, so that was a plus for investors during that time. And while it was true that their revenues were falling, at no point from 2015 to the present has this company been unprofitable. On this one though, I took an extra careful look at their balance sheet because of the difficult years they had there from 2014 to 2018, and I have to say their balance sheet is in a pretty good position. Novartis has $45.7 billion in current assets to $30 billion in current liabilities, and it gets even better with $86 billion in long-term assets to just $33.7 billion in long-term liabilities. And I would say this looks like a very secure balance sheet. But now let's talk about their dividend program. Novartis pays an annual dividend, so if you're someone who likes immediate results, this might test your patience. Getting a dividend one time per year is pretty hard to wait for. But that said, their dividend has grown very well since 2008, and only flatlined through the mid-2010s. But overall, this is solid dividend growth if you look at the chart. If you invested $10,000 in Novartis in 2018, that $10,000 would be worth $13,621, turning on average 7% annually versus 10.5% for the S&P 500. Even though it underperformed compared to the S&P 500, I included it on this list because of the size of the company, their qualified dividend, and the international exposure this company brings, which I think some investors might find valuable. Because I personally think it's important to not only be invested in US companies. This is one of the most interesting companies on this list in my opinion, and I'm certain this company's float under the radar of not only most dividend investors, but most investors generally. Compass Diversified Holdings, or CODI, ticker symbol CODI, is a $1.5 billion market cap company that is a publicly traded private equity firm specializing in acquisitions, buyouts, and late to middle market investments. The company IPO'd in 2006 and currently pays an 8.79% dividend yield. What makes this company under the radar is that very recently in 2021, they changed their corporate structure to make it easier for normal investors to own the stock. Before this company reorganized into a corporation, CODI was a publicly traded partnership, which means that investors had to file these difficult K-1 forms to the IRS on tax day, and the K-1 forms generally made owning the stock a headache. But now with that reorganization out of the way, it's a lot easier for me to talk about this stock on my channel. One really unique thing about CODI is that because it's a private equity, as the name implies, usually it's very hard for an investor to get access to private equity investments on the stock market. And it's generally known that private equity has some of the best deals for investors, but also has higher risk, making it interesting and sometimes desirable for normal investors to get exposure to. I think many people have given the chance they would love to get a private investment into SpaceX or other private companies out there. And this is especially because most stock gains or gains in investments are actually made when companies are in their private stage for insiders as that company grows, and then only later when that stock transitions from private to public is that stock dumped on the normal stock market for normal investors to buy and sell. But at that point, they're already more mature companies and most of the growth had already been paid out to insiders before that company IPO'd on the stock market, which then, as you can guess, is how most private equity and angel investors make their money. So having access to private equity investment on the stock market is a very rare thing. CODI had one unprofitable year in 2018 and grew their revenue more years than not, and after their tax structure changed, the company actually grew their revenues dramatically in 2021 and in 2022. One downside is that more years than not, CODI has diluted their shareholders with as recently as 2021. And at that time, in 2021, They diluted their shareholders by 3.5%. They don't have many dividend increases on record, which is a negative thing, with just one in 2021, and their dividend did drop in 2022. Their debt situation is quite good, with $1.15 billion in current assets to only $356 million in current liabilities. Their long-term debt situation, though, isn't as good, but it's not really in a red alert danger zone scenario either. They have $1.9 billion in long-term assets to $1.4 billion in long-term liabilities, and overall that's not great, but it's not terrible either. So that's something I would definitely keep an eye on as an investor. If you invested $10,000 into CODI, you could expect about $442 a year in dividends, with $110.50 paid out to you each quarter. But of course, this is subject to change as their dividend hasn't been the most consistent. Mostly thanks to CODI's 2021 and 2022 performance, this company has outperformed the S&P 500. If you invested $10,000 in CODI in 2018, that would be worth $19,250 today, returning on average to you 15.48% each year. And that's compared to just 10.5% for the S&P 500 since 2018. Before I continue with the last three picks on this list, I'm going to give a few honorable mentions to a few companies that are just barely on the list, but I won't be covering in full because of their revenue problems and their low dividend yields. The first is Coterra Energy, or CTRA. This is an oil and gas development company focusing on the United States. This is one stock to look at if you think that the US will focus more on domestic production of energy and fossil fuels because of the conflict with Russia. Then moving on quickly, next up is Emerson Electric Company, or EMR. This one pays a 2.45% dividend yield, and they focus on electric equipment such as thermostats, but the products they create really vary, going from heat ignition systems from furnaces to industrial valves. It's really all over the place. The revenue has been pretty much stagnant over the past decade, so that's why it didn't earn a full highlight in this video. But it could be a good investment if you like large cap, mature dividend payers that focuses on real industrial production and isn't a tech stock. There's also really quickly Dow Incorporated, or ticker symbol Dow. This one went public on the stock market in 2019, so it's hard to evaluate its stock performance over a long period. Its dividend yield is 5.3%, and it does have a very significant market cap of $37 billion. And this is one of those chemical and plastics companies. They produce everything from plastic packages to latex powders. They have really solid revenue growth after the IPO, but before that it was stagnant for years, so it's hard to make a judgment call, so that's why I didn't give it a full feature in this video. Moving on to the final three, we have the ever dividend investor favorite, Kimberly-Clark, ticker symbol KMB. This is a $44 billion company that manufactures consumer products, as in the kind of consumer products that you aren't going to cut out of your budget even if it's a recession. These include everything from consumer tissues to baby wipes and feminine products. But this list of their products is really extensive and worth looking at yourself. This company is by far the oldest in this video, being founded in 1872, and their dividend yield is only 3.55%, which is considered high as far as qualified dividend companies go. It is possible to overpay for this company, as good as it is, so it's important to buy it at the right price if you do decide to buy KMB. Kimberly-Clark's revenue has been growing very slowly, sometimes only 0.5% each year. But at this size, and considering how mature this company is, it is pretty hard to grow your revenues dramatically when you're making tissues. And for dividend investors, that may be a good thing, as they want stable, consistent profit and dividends from their investments. The downside, of course, is that they're earning about the same revenue now as they were in 2012, but at the same time, too, they have been consistently profitable and have been consistently buying back shares, dropping from 372 million shares outstanding in 2014 to 337 million shares outstanding in 2022. But I next need to draw your attention to their debt situation. Their short-term debt, frankly, is not good. They have $5.9 billion in current assets to $7.2 billion in current liabilities, and their long-term assets are $12.7 billion to $10.5 billion in long-term liabilities, which is better, but it's not a comfortable margin of covering their debt. So I would watch Kimberly-Clark very closely because they don't have a lot of room to maneuver and their debt could easily creep up on them. KMB's dividend is remarkably stable, trending up every year since before 1990. This is by far one of the most mature and established dividend track records I've ever seen. Unfortunately, KMB has not outperformed the S&P 500. If you invested $10,000 in Kimberly-Clark in 2018, that investment would be worth $12,913 today, returning to you on average 5.78% per year. And as we know from the other stocks in this video, the S&P 500 returned 10.5% annually over that same time period. If you invested $10,000 in KMB, you could expect about $352 a year in dividends paid out to you at about $88 a quarter. Coming up here on the end, second to last, is Marathon Petroleum Corporation, or ticker symbol MPC. As of this video's release, for full disclosure purposes, I do own this stock. And if you want to see a full disclosure list for all the stocks I owned while making this video, check the description. This is a $46 billion market cap oil refining and midstream crude oil company. It IPO'd in 2011 as a 2.71% dividend yield, which is on the lower side, but it's still good enough to be included in this video. Now, of course, with the price of oil as erratic as it is, there has been some revenue inconsistencies for this company, but to their credit, they have been growing revenue steadily since 2016. In particular, their revenue has blown up during the last 2 years because of disruptions to the supply of oil. Their only unprofitable year was in 2020 because, as you can imagine, that was mainly due to lockdowns, and also an unusually high amount of operating expenses that year. They did have to heavily dilute their shares in 2018 and 2019, but since then they have been steadily buying back shares, which is good. Their dividend has been frozen the past years, not growing, but before that point it was growing in the double digits, and it's possible they could start growing their dividend again in the future. Marathon's debt situation is really good, and while it's not the best in this video, this is one of the better ones I have seen. They have $36.3 billion in current assets to $25.1 billion in current liabilities, and $54.5 billion in long-term assets to just $34.5 billion in long-term liabilities. And when you compare Marathon's performance since 2018 versus the S&P 500, it is really quite close. But with the major damage the coronavirus lockdowns did to the price of oil in 2020, it looks like Marathon's performance was dragged down just enough to lose out to the S&P 500, with Marathon returning on average 9.59% annually since 2018 versus 10.5% for the S&P 500. Their dividend program is relatively mature, having started in 2012, and their dividend has been growing steadily since then, only taking a pause starting in 2020. If you invested $10,000 in MPC, you could expect around $271 a year in annual dividends, with on average $67 paid out to you in dividends each quarter. The very last company on this list, which is a boring company but in a good way, is Whirlpool Corporation, ticker symbol WHR. This is a $9.4 billion market cap company that manufactures home appliances, focusing particularly on water-based ones, like refrigerators, water filters, and dishwashers. They own brands I'm pretty sure you've heard of, such as Whirlpool, Maytag, and KitchenAid. Their dividend yield is 4.15%, which is one of the higher ones on this list. And their revenue is a little bit choppy, growing some years and declining some other years. And I would say this is a mature business that has reached saturation and is growing slowly compared to other companies. That said, though, WHR's revenue has been growing, starting at $19.8 billion in 2014 and ending with $21.5 billion in revenue as of 2022. They only had one unprofitable year in 2018, and they have been buying back shares consistently since 2016. With 1 year, they bought 9.6% of outstanding shares, which I can imagine was very popular with investors. Their debt situation is on the border between good and bad, and it will need you to keep an eye on it. Their current assets are $8.9 billion, and their current liabilities are $8.2 billion. With long-term debt, the situation gets much better, with $10.5 billion in long-term assets to $6.4 billion in long-term liabilities. A good portion of their long-term assets, though, are goodwill and intangibles at $4.4 billion, so that makes their long-term debt situation appear better than it actually is, but at the same time it's not a disaster. Their dividend program, on the other hand, is really quite impressive. Starting in 1989, overall they have consistently raised their dividend since 2013. The only time they cut their dividend program, which is when it was suspended completely, was in 1997, according to Seeking Alpha. Unfortunately, Whirlpool underperformed the S&P 500, only returning on average 3.19% each year, compared to the S&P 500's 10.7% since 2018. The appeal of this company is the relatively high dividend yield, which is above 4%, and if you invested $10,000 in Whirlpool, you could expect around $420 in annual dividend income, with about $105 paid out to you every quarter. I think the appeal of the stock, if it has one, is to late-stage investors who are further down in their investing career, looking for a high-yield, consistently growing qualified dividend. For more growth-focused investors, this company obviously might not appeal as much, but overall it's worth looking at. That's all for this video. For the next one, watch this video I made about the best monthly paying dividend stocks. And these companies are for when you don't want to have to wait an entire quarter to receive your dividend. You want them faster and on a monthly basis. Follow the Telegram channel and become a member of this channel. That's all for now.